Hello everyone, good morning. Clifford Bennett, Chief Economist, ACY Securities, and welcome to another exciting week on planet Earth and amongst all, of course, the economics and financial markets of the world. Yes, bit of a spring in our step this week. Lots of exciting things happening. Economic data, really, it's a horror movie. We had German confidence just fall away again into a 10-month low, deep in COVID lockdown territory. You can't get much more bleak than the German consumer and business outlook, which makes it highly unlikely consumers are going to be overly active or businesses spending a lot of money to gain market share in a downturn, which is probably what they should be doing, but they're all so depressed and probably thinking of moving elsewhere, away from Germany's troubles, that I can't see that economy rebounding very much at all. And in fact, second quarter GDP for Germany was flat, which means some people say that means it's out of recession because it had two negative growth quarters and then it's flat. I think that means it's still in recession. It still hasn't achieved economic growth. And the current quarter could be far worse, and the fourth quarter worse again. Then we move to China and we have industrial firms profits there still down over 15% on a yearly basis. However, they are rebounding on a monthly level. There's a bit of a recovery on the monthly basis. I'm not sure how much longer that will last. It's been a very gradual crawl higher in terms of profitability, and nowhere near the previous levels, of course. So still rather significant problems there for the Chinese outlook. And then we move over to the United States, where we have the Chairman Powell, basically parroting what I said he would say, and confirming a very strident tightening bias. And while the market seems to be excited that there won't be a rate hike at the next meeting, which he said, no one expected or thought there would be a rate hike at the next meeting. So any rally using that as some kind of bullish spin story is hardly going to last very long at all. What we do have is the Federal Reserve Chairman saying that he is prepared to raise rates further. And I've kept warning everyone that there's not going to be a pivot. It's still so funny. I still get comments on social media about, but they're going to pivot. From day one, the first time I heard the word, remember I laughed on camera. It's always been a nonsense. I don't know where people get these ideas. I know, because it's what they want to believe to support their bullish long positions. Well, the world rarely gives us what we want. It usually gives us reality in the end. And that remains the Achilles heels of the US stock market, reality. So the Fed, now, of course, the Fed raising rates or staying up here by itself does not mean, I can do, I can do how does that work again? I remember I used to be able to do that really well. The dog barking. Anyway, can't quite get it going today. So I know. Yep, that's the pivot flying away right there. Gotta have some joviality in our daily routine. There you go. You can have jokes even in economic rants. How's that for entertainment value? So, stock markets can rally when central banks are raising interest rates. And I wrote a great paper on this when I was at Macquarie Bank 20 years ago, and I've always argued people should be aware that interest rates and stock markets, equity valuations, prices, often go in the same direction at the same time because they're responding to the same stimuli. So when you have an overheating economy, of course, profits are going up, you buy shares, and the central bank's raising interest rates, and both things happen together. Simultaneously, things are going bad in the economy, the economy is slowing drastically, profits are falling, therefore you need to be selling stocks, and the central bank reacts by lowering interest rates. So they fall together, they can fall together and they can rise together. And they do that as often as they do the opposite, where everyone thinks, oh, if you raise interest rates, the stock market is going to fall. No, nothing of the sort. That's not a rule. Why we're bearish, I am bearish, the equity market, and I've been telling you to be cautious all through the recent stages of this rally, previous rally. It hasn't been a rally for a couple of months now. We're really into heavy price action territory again. Is that the underlying fundamentals are incredibly diabolical for the US economy. Again, I will try not to chuckle at the people who say the US economy is strong. Yeah, I'm not sure where they did their economics. US economy is not strong. It's in terrible trouble. And at the same time, so this is why I'm bearish stocks. At the same time that the Main Street economy is under a lot of pressure and headed lower, the Federal Reserve is fighting a new kind of inflation animal that isn't driven by an overheating economy, but is driven by supply disruption, supply constraints, and a loss of globalization power and momentum, which means that people can again raise prices without losing market share in their domestic markets. So you're still getting, and inflation is rekindling. It is reaccelerating as we speak from energy and food prices. So be aware of that. And companies again beginning to price in fatter profit margins because they can see the uncertainty. That's why they've been laying off staff in the US. So you've got a central bank in this scenario raising interest rates as the economy is weakening, which means the economy is going to weaken much further, which means that equity valuations are just getting more and more stretched from the underlying fundamental economic reality. And as I like to point out, on this occasion, unlike the GFC, where China remained strong and helped anchor the world economy, this time China is having its own serious problems. The EU is in terrible shape, and the United States itself is suffering a very bizarre domestic economic dysfunctional period and overall beginning to weaken. So, someone said to me the other day, Clifford, you've been bearish property and stocks for 2 years. Yeah, and property and stock prices are lower than they were 2 years ago. So people get so tied up with the daily headlines trying to spin a positive outlook, forgetting that these markets have been falling for some time now and continue to fall. Yes, we've had a 6-month rally in US equities, but not back to the previous highs where I became bearish. And that rally is petering out, has petered out, has topped out, and is rolling over. And that is the risk that everyone needs to be aware of as we go into yet another exciting week of global financial markets. Thank you very much.